Hello, everybody. We're going to get started. I want to thank everyone for their interest and their attendance on this webinar. My name is Jeff Lusick. I'm the head of the retail sales team at Horizons ETFs. I want to welcome you for today's webinar on the Canadian preferred share market and fixed income outlook with Nicolas Normandeau, who's on the Fiera Capital's corporate fixed income team, and he's the lead portfolio manager for the preferred share ETFs that we manage. So before I get started, I'd like to go over a few items so you know how to participate in this webinar. You will have the opportunity to submit text questions to today's presenter by typing your questions into the question pane on the control panel. You can send those questions in at any time. I will be reviewing those questions and we'll be trying to address some or most of those at the end of the call. And if we're not able to address them all, we'll try to get back to everyone within 24 hours with an answer to your question. So I just want to also make you aware of the handouts that are available during this webinar presentation. The presentation itself is available. Our active income ETFs brochure is available. Understanding preferred shares piece and the product sheet for the two specific ETFs, HPR and HFP, are available for download in the handout pane at any time during this presentation. And also note that this call will be recorded and we'll make it available after the webinar, so you'll be able to listen to the content at any time. So to start us off, I wanted to sort of preface why we're here today. The primary goal is to discuss the Canadian preferred share market, but we'll also address the credit markets. But we chose to have this discussion today. The last time we had a call on the preferred share market, it was in early December, and it was a difficult time for the preferred share market. And at that point, we talked about the tax loss selling was presenting a challenge for the preferred share market, and it sure turned out to be the case that there was a lot of pressure on everything, but specifically preferreds until December 27th. And there was a bounce off of that last day of tax loss selling, sort of on December 27th. But since then, the credit spreads have narrowed, bonds have appreciated, but preferred shares have not participated in that as much as the bonds have. So we're going to address that a little bit today and an update on the situation with preferred share market and present the opportunity we see going forward. So with the agenda, as mentioned, we'll get a market update, an update on preferred shares, and again, an update on the fixed income markets in general. But I also want to really highlight our partnership with Fiera Capital by highlighting the entire lineup of ETFs that Fiera Capital sub-advises for Horizons, beyond just the preferred share ETFs. We do believe active management can make a significant difference in the fixed income markets. And to demonstrate that, Horizons has won the best bond ETF family at the recent Lipper Awards, which speaks to the depth of our lineup. So in addition to our two preferred share ETFs, HPR and HFP, we've had a lot of success in the lineup. HFR won the best Canadian short-term fixed income ETF, and Nicolas Normandeau works on that team as well. And HAD won the best Canadian fixed income ETF. So we're proud of our depth of offerings at ETF and how well we've done with our entire lineup. So there's a lot of other opportunities in addition to our preferred share ETFs. So Nick does work on the integrated fixed income team, where they are all true credit analysts. So he's going to discuss preferred shares. He's also going to discuss the credit markets. And that team itself manages approximately $25 billion in assets. So I'm just going to quickly show the performance of our two preferred share ETFs against some other well-known preferred share ETFs. You might notice a little bit of a slight underperformance in the 6-month and 1 year, which is actually quite rare for our preferred share ETFs, as they've historically been consistent outperformers over most time periods. But this is where we see the opportunity. Nick and his team had an overweight in the discounted rate resets, and that's where he still believes there's still the value, but I'm going to let him expand on that later on in the presentation. So I'm going to pass it over to Nick. Nick has been on the team running our preferred share ETF since the beginning. A lot of experience and expertise in this space and credit market space. He has a BA from Sherbrooke University, is a CFA, and again, a true credit expert. So I'm going to pass it over to Nick, but I'm going to try to keep it interactive as well throughout the presentation. So Nick, if you could take over.
Thank you, Jeff. So good morning, everyone. So since our last webinar, it was really rock and roll, I would say, in the pref market. And so I think at some point we lost like 6% more. We came back almost flat. So we're kind of almost flat since the 1st of December in terms of performance, but with a lot of volatility. So today, like Jeff said, I'm gonna touch on rates, what's going on, where we think it's gonna happen with rates. We're gonna touch also on credit, which rates and credit are two extremely important factors for preferred share market. And after that, we're gonna go more deeper, let's say, in the preferred share asset class. Talk about the market, how come it's not outperforming as much as everything else, and our expected return for the year, our positioning, where we think there's more value, let's say, and that's kind of it, what we're going to do today. So if I start with rates are really in free fall right now everywhere on the planet. I would say that since the peak of the fourth quarter of last year, rates are, like, let's say Canada 10-year rates are anywhere from down, let's say 60, 70 basis points. You can say the same with the US. You could say the same with the UK yields. Like, it's everywhere. It's really, really decreasing. And if you look on the page 8 on the side, the market is really just focusing right now on the right-hand side of this table. So the market is focusing on tariffs, that it's not resolved, that we could see more tariffs on March 1st if there is no agreement between Trump and the China, right? Also, market is focusing on China slowdown, which is, tariff related, but still, there's also a slowdown in China. Brexit also is a big focus right now. Is it going to be a hard Brexit or no? Right? There's they have to sign this by the end of this quarter. So a lot of potential volatility that we could see. And I would say also what's also driving rates lower is every central banks are way more dovish now. Start with the Fed, that now they're kind of say they're going to be patient and see how the economic numbers will be to decide if they're going to hike further or no, right? Same for the Bank of Canada, that is now also focusing, lower oil was affecting the Canadian economy, also trade war, and also their focus also is the housing market, that with the hikes that we have seen last year, we're kind of seeing a little bit of weakness in the housing market in Canada, mainly Vancouver and Toronto. But you also have the ECB that is dovish now, and then it's not about to hike, right? With growth being in the low 1%, no much inflation also. And this morning it was the Bank of England, BOE, that was also really dovish, reduce their growth potential. So all in all, when you kind of look at this, the market is really just focusing on the bad news, and they kind of forgetting all the left-hand side of this table. The market is kind of not really focusing on the fact that, inflation in the US is still around 2.2, so it's on target, right? Employment is on fire still. Last month, employment growth was really, really strong, above 300. So average early earnings is still above 3%, 3.2 to be precise. And there's still going to be a lot of budget deficit, so a lot of funding needed by the Fed. So all of, I would say, kind of good news, but the market is just really not focusing at all on that. So they're going to be patient. Right now, as we speak, market with its pricing in the US is zero hike for the year, and in fact, a little bit of chance to see a cut in December, 15%. Right? It's not a lot, but still. So no hike at all price in the US. And in fact, if you see, like, over the next 2 years, one full cut is priced right now as we speak for the US. So a lot of bad news is priced right now, as we can see. For us, we think that for the Fed, we're still going to see one hike this year. Of course, later, probably the fourth quarter. And that's the 10-year rate US should at some point go back to 3%. Maybe not the most recent highs that we saw in 2018, which was around 325. But we think we're going to see again a 3 handle on the 10-year US. So that's our forecast. For Canada, like I said, the bank also is in the patient mode. Want to see some better news on the trade war. Oil, good news is that it's way better now than what it was a month or two ago. The discounted WCS is now $10, I think, which used to be way bigger than that. So that's good news, but the oil is not 60 plus, right? So it's still in the low 50. So we'll see, but at least with that type of oil market, they're not about to cut, right? I understand that they will be patient. Again, our forecast is to see one more hike in Canada late in Q4. But we don't expect any cuts, and that's important. And that's important for preferred, right? And our target for the 5-year Canada, which is so important with preferred shares, is anywhere from, let's say, in the range of between 175, which is the overnight, which, by the way, we're really close to that right now as we speak, and 210. We don't think 5-year rate will go way more than 210, right? So that's kind of our range right now. 10-year, we think we're going to go back around 230, but not much more than that. But that's what's important, is that we don't expect any cut, no recession, maybe slow growth. Totally agree. Growth will be way weaker this year in Canada, maybe around potential, which is fine, right? But the good news is that with both the Fed and the Bank of Canada and other central banks to be more on the sideline, and because inflation is not really high, they can be patient. Well, that was extremely good for credit. So if you turn on page 11. You can see what happened with spreads here. Q4 was really difficult, right? Investment grade spreads were wider by 30, 34, 40 basis points. If you look at the midterm corporate investment grade in Canada, that was really that happened extremely quick. It was, I would say, painful. And the last time it was that painful for corporates versus Canada for the same duration, it was back in 2011, right? So it's kind of been a while that we saw these type of underperformance, but it was just not Canada alone, right? Also U.S. credit, and in fact, every credit out there will also underperform, and mainly in the fourth quarter. Same for investment grade corporate U.S. that were wider for the year, 50, 55 basis points, and 44 for just one quarter. That's a big repricing, I would say. And high yield was also suffering a lot with more than 200 basis point widening just in the fourth quarter. So it was a painful credit, but the environment. But since then, the market is on fire, right? As we speak right now, spreads are in for investment grade for January, but it's still tighter as we speak right now. It's about 18 basis points tighter for Canada. So we're kind of retrace almost half of the widening that happened last year, right? In just a month and change. And you can say the same for US, which is also the spreads are in by 27 basis points. And even high yield, 120 as we speak, probably slightly wider today with a weaker day, but still, it has repriced a lot. The market, they kind of like the fact that central banks will be patient and really, like we saw, really big retracement. And we also saw the same type of environment for equity, right? Was looking at it this morning. S&P 500 is up 8.4% year to date, and almost 10% for the TSX in Canada. That's really good performance for just 1 month. And it's kind of weird because it's only on the fact that the Fed and the bank, like I said, will be more patient. And it's not because the economy are doing really that much better, right? So that's kind of what happened. If I jump into the preferred share, page 14. Yeah.
Nick, just on that, you reviewed your view of the Government of Canada 5-year rates, which obviously are quite important to how prefs trade. So you might be addressing this later, but I thought it would be a good time to ask you that, even if the rates are in that range, are you anticipating a lot of the issuers will reset at higher levels when they come due?
We're going to see it later, Jeff, but even with rates around 180 for the 5-year rate, we kind of the reset of the average yield of the portfolio will increase over time, right? Because mainly starting in 2020 and 2021, because if you remember 5 years before, like in 2015 or early 2016, we were resetting a lot of the reset issues with a 5-year Canada at 0.5%, right? So rates have decreased, but we're not at all at 0.5. We're at 179 as we speak, 178. So, which is still, I would say, okay. So
Okay.
we don't think rates will be a main factor, right? In fact, I should say we don't think rates will decrease much more from the current level. So that's the good news. But they're not going to increase that much too from the current level too, right? So we think we're going to remain in that range, as we don't think the Bank of Canada will cut this year, right? So there's no reason to see 5-year rates going lower than 175 for more than one day, right? If the bank don't cut, right? You're not going to see the 5-year lower than the overnight rate.
Yeah, I just wanted to highlight that I think that even if the 5-year rate stays in that range, there's an opportunity there still with some of those preferreds resetting at higher yields.
Yeah.
And we're not dependent on the 5-year rate going up. Okay.
No,
so,
not at all.
So sorry if I stole your thunder from further on, but go ahead.
Okay, so I'm on page 14. So Canadian preferred share. So of course, with the environment that we saw in the fourth quarter with lower rates, with the underperformance of credits, equity, high yield, investment grade, and also with really not great technicals, the market got crushed, right? The market was down 10% alone in the fourth quarter and finished the year, let's say, down 8%, which was really, really bad, I would say. And I want to touch a little bit on technicals, but supply demand was not great, right? You all know that this market is a small market, it's illiquid, and usually when the market is softening, well, you can see even more volatility, right? So a little bit like 2015 when rates decreased, but decreased way more, right? At 0.5 for the 5-year, like I said, with wider spreads and really just sellers, the market in 2015 got crushed big time. And it was kind of a repeat again this time with maybe less, maybe less because of rates being so low, but it was also a big change in mind to investors of seeing maybe more hike to, no hike at all for a while, and maybe at some point there were some cut price in Canada. So that was kind of a big change also, and also, like I said, a big repricing of credit. But again, this time it was, I would say, maybe a little bit more exacerbated by flows, right? Investors were reducing their single lines, but they were also reducing their ETF exposure in all ETFs, and it was massive, right? And the way usually people trade ETFs is you ask a bit to your market maker. These guys, well, what I like to explain last time, when they're kind of bid everything they can, after that they have to hedge themselves, so they're selling the market. And like I said last time, these guys, when they have to sell, they sell, and they don't really care who is buying what, who is buying Royal Bank A versus C's and D's. They are selling. They're selling the market, right? So because of the outflows, they have no choice. So really, that really, I would say, exacerbate the underperformance. But it was also, like Jeff said a bit earlier, the tax loss. Tax loss season last season was crazy, right? People were trading huge size, lots of ETF, even for HPR. Like one day, trade more than 10 million shares, right? That's a lot, right? So it's like 10 times more than usually. But we were seeing lots of different flows from one ETF to another, and it was just really, really intense. And usually at some point, like the tax loss kind of end around mid-December, and after that, investors start thinking about Christmas or whatever else. But this time, no, we saw tax loss until the last day that it was possible, until December 27, right? And when you settle on T+2, it was still in 2018. So it was really, really, really intense this time. And just between like October 4th, which was the high of the year, and December 27th, the market lost almost 15%, and the rate reset even more, close to 16%. So I would say that was really, really intense. And now when we look at it as of today, the market has kind of repriced a little bit, but it's up. Well, before today, now the market today is down, but let's say before today, it's up, let's say around 1%. So that's not much, right? Versus what we are seeing in investment grade credit, in hybrids in the U.S., in Canada also, in high yield equity. So really the preferred share market is underperforming right now, and I'll try to explain why in the slides coming. So if we continue to do like a little bit of a recap, if I go to the page 15, everything that was a rate reset, that was a low rate reset level, let's in the 200, but even the 300 resets, which was a little bit surprising, well, they got crushed big time in the fourth quarter, right? They lost anywhere from 14-15% just in the and even some like 18-19% just in one quarter, right? But if you add the higher resets, let's say what's high reset, it's like above 400 for good names. Well, these ones for the fourth quarter lost a little bit, but like 1%. So it was massive difference between the two, which was almost the total opposite of what we saw in 2017. This year so far, well, these are numbers out of January 31st. They're all kind of performing a little bit the same. I would say, generally speaking, because the February was slightly better, let's say the first days, not today, but the market, like the lower resets are a little bit outperforming right now. So that was a massive correction. And if you go on page 16, what I think is important is that even despite, like as of yesterday, despite the small rally that we saw over the last few days, well, we're kind of back to October 2016 as we speak level, and at that time the 5-year rate was 75 basis points. So we're still a little bit like 100 basis points more than that. So based on that, this market is it's kind of attractive, and it is pricing a lot of bad news, right? And if you look in total return, we're back to June 17, right? And at that time the 5-year rate was around 1%. So I would say, like I said, the market is a little bit is attractive based on yield and the fact that rates is way higher than it was before, and that we don't think right now that the bank will cut. So what's the problem? Go on page 17. The problem is the technicals. What's that? Well, there are way more sellers than buyer, right? Looks like the repeat of really weak performance in 2018, a little bit like 2015, and the fact that, again, it was as volatile as the equity market. I think, well, we're kind of seeing a little bit of investors disappointed with the asset class, and these guys, with any opportunity when you rebound, they are kind of still want to reduce their exposure, right? So that's, I would say, one of the first reasons for that, the fact that the market is not outperforming. And as you can see on this slide, well, since October, well, outflows are in the 140 million area in the passive ETFs, but also active ETFs also are getting outflows this year, right? It was kind of finished flat and even positive for the fourth quarter of 18, but we're kind of seeing a little bit of sellers. So we are still seeing some sellers. Buyers are not really coming back, right? And if you go on page 18, which were the supply, right? Supply was not a problem in 2018 at all, right? It was not much supply, and net new issuance was just 2 billion, mainly banks, but still, it was not a problem. But supply is coming, right? And that's the other problem that we think right now for the pref market. We will get supply. Banks will be active this year. They already started with 3 deals this year, like CIBC, TD, and Canadian Western Bank. So remember, right, between late 18, like December 18 and June of 2019, banks have to redeem close to 5 billion of Tier 1, mainly hybrids Tier 1 that they issued during the crisis. Right now, they're not in VCC, all of them, so they will call them, right, for sure. So which means that they will print probably the only market, not the only, but one of the market available for them, and I think the cheapest market available for them is preferred. So we should expect all banks printing. We will see supply from banks every quarter, right? But they won't be alone. Manulife and Sun Life too have some redemptions of old hybrids at the end of this year, right? Manulife has 1 billion of redemption, Sun Life 500 million, right? So 1.5 for the life insurance. So we will get supply, and I think that's the reason why, right? The market started really well in the beginning of this year, right? 3% up. Oh, guess what? CIBC new issuance, TD not long time after that, and boom, the market like lost 3% on supply. So supply is important, and even more when it is banks and life insurance, which are our best credits in the universe. So this will continue to bring volatility, right?
So Nick, just a quick question. So you do anticipate continued new issuance in 2019, and then, what type of spreads do you anticipate seeing with some of those new issuances?
Well, we got, like I said, three banks this year. CIBC was the first one with a 5.20 coupon, which was reflected. You can see this on page 19 with a reset of 3.31, was the first one, which was, I would say, when the market was up 3% at that time, it was fair, right? Maybe CIBC is not the best credit of all the big five banks, but it was, I would say, fair, right? And after that, we saw TD around the same type of resets level, same coupon, 327 resets, which was also, I would say, okay attended by investors. We got like close to 18, 20 buyers on both deals, institutional buyers. That's kind of on the lower end, so it was just okay. And it was way better than the last deals of the year last year when RBC prints with a reset of 238. So we got almost 100 BP better reset, right? So at that time when the RBC print had really tight level, there were just 5 buyers and 2 forced buyers out of the 5. I'm not gonna name them, right? But if you look at all the new issuance, CIBC, TD, Western Bank, and BIP or BIK, they're all trading at premium, right? So they kind of outperformed. So even if we're gonna get more supply, I think 520 is the number. I don't expect banks printing with wider level than 520. But now with the 5-year rate slightly lower, the reset will be around 340, which I would say is kind of okay, right? But I think we'll see wider resets over time this year, 350 plus. So that's our forecast on that. For us, we pass on all the banks in our active accounts, right? Why? Like I said, they were fair, but the secondary market was way cheaper, right? Because after this CIBC deal, you saw really softer market out there. And just give you an example, I was able to buy another CIBC R, right, with similar reset, even slightly better reset than the most recent CIBC one with the reset of 338. But that one was trading $2 cheaper. It was trading at 23 at some point and even lower. And I know that the coupon is is lower, but that's worth not even $1, right? So in fact, they were kind of $1 cheaper versus the new issuance, and it was also possible to find some. So $1 is $1. $1 is 4%, right? So that's important. So that's the main reason why we pass. But above 300, usually it's okay in terms of resets. But I think we'll see, like I said, slightly wider reset over time this year. So if we jump on page 20, just before, we'll see financials, but I don't expect much non-financial issuers, like names like TransCanada, names like Emira, CUs, all these good credits, right? Well, they're going to tap the hybrid market, right? For them, it's so a big advantage. It's interest income over dividend for like preferred. So after tax, it made total sense for them to print hybrid. So I would say the good news in terms of supply. And banks, if for whatever reason the pref market is a little bit closed, they also have options. They can go in the US, they can do an hybrid. They can also do an hybrid in Canada. Same for life insurance. So I just say that supply will bring volatility like always, but at least issuers have other options if for whatever reason this market doesn't want to buy the new issuance. So if I jump on page 20. With all these numbers were as of January 31st, but they're about the same right now. The average current yield in the pref market is around 540. After tax advantage, you're at 7%. So just on yield basis, it is cheap, right? It's better than the high yield. I know volatility can be bigger than the high yield. I get it, but high yield, the yield to worst as we speak is 670, right? So the yield on preferred is attractive. And if you go on page 21, you can see our positioning. HPR yield is similar. We're at 540 right now. So like I said, around 7 after tax. And what we like, and of course it was a bit painful in the fourth quarter, but we still prefer that trade at discount, right? Here, I'm not talking about the one with a reset of 120 and change. No, we're talking about like the let's say the sweet spot is anywhere between 220 and 350 almost, right? So this is where we think there is most value, right? So as you can see, we have the way we're kind of presenting them. We have a lot of preferred trading at discount now, more than 80% or a dollar at this dollar discount, which is more than 10% more than the universe. And like I said, you don't necessarily need higher rates. Of course, it's good news if rates increase, but you don't need lower rates, of course, also at the same time, right? And we think we're really at the lower end of the range, and we could see higher rates. So that's the reason why we're keeping that bad. But it's also because these lower resets also are supposed to benefit of also a stronger credit tone, which they are not really at that time. And that, I think, will come with buyers, right? So that's kind of our positioning. We have a little bit of floating. Yeah.
Next, so one just quick question, just to sort of clarify. So then how much of the portfolio right now is sort of in what you consider discounted rate resets?
As you can see on page 21 on the bottom table on the left side, we're 73% at discount. That's the full portfolio. 73% is at discount. For me, discount is $24 and lower, right? So dollar discount. Okay. But you can see like we're 65% in preferred that trade at $22 and lower, right? So wow. So okay. The universe is really trading a bit of discount now with the sell-off that we had last year.
Okay, so yeah, in that chart at the bottom. Thank you.
Yeah. So on the structure allocation, we still have floater preferred. We're at close to 6%, and it's not because we think the bank will hike, right? Yeah, maybe we'll see one later, but that's not our bet to see more than one, whatever, right? So a lot of that exposure are banks not in VCC, which even if they have low resets, they're not in VCC. We think they will get redeemed. So and they're cheaper than the fixed side, right, for most of them. And also on the other floater that we have, well, we think that, not we think, but within a year or two, most of them will have the opportunity to stay float or go back fixed, right? So, and we don't expect the bank cutting over the next year or so. So that's kind of we have a little bit of perpetual. We like them, right? Not all of them, but Great West around 570. We like that. We're buying of that. We're overweight Great West. We're okay also with Sun Life, Manulife around the same level. CU around 5.6, it's okay. BRF around 6.40, 6.30, it's perfect, right? So we're okay with perpetual. I get it. There's probably less upside short term, but there's also much less downside if we're wrong and rates start decreasing. But I think where the value is on the discounted reset. So if you go after that on the sector allocation, well, we still like the utility, mainly because of Brookfield Renewable Power. You can get 6.8% even with the lower rates environment that we're in right now. So for BRF, which is really great. We also still like AltaGas. You're even bigger yield. You're at 7 point of them. We don't expect further cuts of AltaGas, so we think they will remain triple Bs in the senior and secure, but also will remain P3 in the preferred also. So that's why we like them. We also like BCEs, mainly the old structure, I would say. Your yield is around 6.30, so that's good. And it's not all discounted rate reset that we like Brookfield Properties. Yeah, the yield might be attractive, but these guys are running the company with huge leverage, right? So it's a name that we are on the weight. They have great assets, okay, but they are running with too big leverage, we think. We like Manulife. We're underweight in the insurer mainly because of what's the name? Fairfax. But we like Manulife. The yield you can get is around 5.60. That's great, right? When banks can print at par at 5.20 and you can buy some of the lower resets, Manulife at 5.60, that will reset soon. I think that's extremely attractive, right? The pick should not be 40 basis points. If you look on the debt side, Manulife and Sun Life are trading, the sub-debt are trading through the bank's level and the sub-debt and VCC, right? So here we're getting a pick of 40 basis easy. So that's why we like them. We still like energy. Enbridge is on fire on the debt side. We kind of see also some outperformance of Enbridge preferred, but it should trade way tighter than where it's trading right now. You can get easy 650 with Enbridge, so that's why we like them. Pembina also, but you need to be selective on Pembina. In fact, you need to be selective on all of them, but Pembina, they're not all cheap, but some of them at 650, they're okay. Banks, like I said, the sweet spot, it's not the new issuance. Don't buy the new issuance at premium, because we'll get a lot more. It will be easy to buy a lot more banks issues at par, right? So now, like I said, they're all trading at premium. You should sell and wait for a new issuance. But we like the sweet spot. I think it's still in the ones that we call like the mid resets, that are like the CIBCR, National Seas, some BMOs. That's where we think is the sweet spot. And also we like some of the lower resets of the banks, but not all of them. Like, just to give you an example, there's a lot of mismatch between the banks, right? They're not trading at the same levels. Like, they should not trade at same levels. Like National, you can get 550, for example, right now for the lower reset. This is cheap. You can also buy CIBC around 540. This is also super cheap versus new issuance at 520, like I said. You can buy some BMOs at 530. But you also have TD and RBC trading around the low 5%, some of them. These are getting pricey, right? So that's why active is so important, right? And that's what we do all day, try to select the right one. And so that's what I wanted to say on that. So if you go on page 22, Jeff, that was one of your first questions today. Right now, HPR, there's a lot of beautiful colors here, but I tried to explain what's going on in this. It's a coupon or average yield sensitivity to what will happen with the 5-year rates. Okay, so we put different scenarios. Current 5-year rate that's I think blue, 180. You have like even our orange scenario with a 5-year at 1%, and so on. So what we are doing here is that we say, okay, every reset in 2019 will reset. Let's say if you look at the blue one, will reset at a 5-year rate of 1.8, right? So in 2019, in 2020, etc., right? So you can see that you start from 544, and that you have a little bit of upside for the resets that will happen in this year and in 2019, way more in 2020. So your yield, if nothing else happened, which usually that's never really what happened, but we need to put some assumptions. Your yield moved from 544 to let's say close to 570 in 2020, and so on, continue to increase, even at some point close to 6%. Even if rates stay at 1.8, that's important. And what I like with this table, I like a lot of stuff, but the orange one, this is a scenario with 5-year rate at 1%. You can see, of course, your yield will decrease, but it still kind of remain like in 2023, close to 5%. So that's good. Of course, if Canada 5-year go down to 1%, that means the bank is cutting, so we'll be in trouble. But at least the average yield will remain around 5%, right? So what I'm trying to say is a lot of bad news is priced in this market right now. And you can look after that, all the different scenarios with 5-year rates. So there's a little bit of upside for the coupon, depending what happened with the 5-year rate. Page 23, that's also, I think, a really important page for positioning in HPR. And as you can see, we have most of our overweight are for the resets that will happen this year and in 2020, right? That's where we think we'll reach the peak in rates, right? I know rates are not super high right now, but they were way lower not a long time ago. But we think that we could see slightly higher rates this year. And like you saw on the page before, it will be beneficial, right? And on the table on the right side, you can see where we are overweight also on the reset level. Yes, we have a little bit of the one that are really, really low resets, but again, these are bank, not in VCC. They will get redeemed. So that's why we're overweight, because of, if not, we're underweight. And after that, it's really like the two, we start the table with 200, but it's really mainly around 220, 225 and above. That's where we are really, really overweight. And also, I wanted to also point that for the resets that are 400 plus, well, that's our biggest underweight, right? They have outperformed last year. They will always be less volatile than another one, but I think they also have not much upside, right? So, and even like for banks with reset of low 400, right now it's all good. Everyone thinks they're gonna get called on the first call date, which I agree right now. But what if it's getting tougher and tougher for banks over time to print new issuance, that the reset that is right now for new issue around 330 move toward the 400. It's not impossible. Well, we just moved 100 beeps since last September, right? So well, guess what? Maybe some of the 400 reset won't get called, right? That's not what we think right now, to repeat. But I think that the market is not pricing, it's pricing zero extension risk. And if there is more weakness in this market, maybe some of them could get extended, right? It's not too bad because you still have a reset of 400, so you're not going to be too much crushed if that happened. But I can tell you, a lot of investors that are buying this thing are sometimes corporate, sometimes credit funds that want to have a little bit of juice, right? And maybe they won't be happy with an extension, right? So I'm just saying that, right? So right now, it's all good. The expectation for us is they will get called on the first call date, but it could happen at some point that maybe it could get extended. So if we, I'm kind of finished there, but to kind of resume what I said, so yes, rates have decreased. We think we're in the range right now, 175. I'm talking about a 5-year rate, 175 to 10. We're on the lower end of the range. We think that at some point, the economy is not that bad, right? U.S. growth will still be around this year, around 2. Canada, yes, will be around potential. So they're not about to cut. So 5-year rate staying at the overnight rate, that's not good. It's not sustainable. We should see going forward a little bit of higher 5-year rate. So that's good news. Credit, it has performed extremely well. Don't expect this type of outperformance over time, right? But we do not necessarily also expect a big widening of spreads. So we're okay. We think credits where they are, they're fair. And they're still wider versus the tights of last summer. So they're okay, and we don't expect that much widening. Demand, like supply demand, well, everything is up big time, right? But preferred. So I think that we could see buyers coming back, right, based on that. So it makes sense to sell maybe the Canadian equity market that is up 10 to buy the prep that is doing nothing, right? So and the market is illiquid still if you want to sell. But guess what? This market is also illiquid if you want to buy. So you don't need that much new buyers or more motivated buyers to kind of see an upside in the pref market, right? Our expected return for the year is still, as we speak, around 5%, right? That's not great, but it's not great. It's not that bad, right? But it's not 10, 15%. It's around the average coupon, right? Rates won't be like will be a factor of volatility, right? But it's not going to be like we don't expect rates to increase a lot. So one thing, I talk about the credit. I think that supply and still the sellers that are not happy with the asset class will kind of put a cap of the outperformance of the asset class. So that's why we still think that we should do around the coupon this year. So that's how we see this. I don't know, Jeff, if you want to open this for questions.
Thanks, Nick. That was a really great overview of what you think about the rate environment as well as the preferred share market and a 5% return expectation or target or that you just mentioned is still quite attractive in this environment at these levels, especially a tax efficient 5%. So I just wanted to summarize by stating that at Horizons we believe being active in the fixed income space can add value, and especially in the preferred share space. And Nick and his team at Fiera Capital have been very successful doing that for us as sub-advisors for the Horizons ETFs. And that's due to their expertise coupled with the low fees that we have on our ETFs. So this is truly bringing Fiera's institutional expertise to the retail investors at a very low fee. So how are they able to do that? Why Fiera Capital? And that's through you and your team's true independent credit analysis. You don't have to rely on the credit rating agencies. You're doing the work on all the credits themselves. Valuation analysis, you can avoid those what you feel overvalued issues. Unlike a passive manager, you don't have to buy those overvalued issuers. The institutional access Fiera Capital gets true institutional access to new issues. It is very selective on portfolio additions, and gets a lot of those first calls if there's big block trades, and then Nick and his team can decide on if they're interested in that and at what price. And again, a reminder that the tax efficiency of the Canadian preferred shares, the distributions paid out of around that 5% are Canadian eligible dividends. So tax efficient in a taxable account, very tax effective. I also wanted to remind people of the in-kind subscription process that we offer. If anyone has individual preferred share ETFs, what we're able to do is offer you an in-kind exchange where you're able to trade your individual prefs for our preferred share ETFs on a NAV over NAV exchange without having to sell your individual preferred shares in the market, but it is still a taxable event. So if you do have questions on that, please feel free to reach out to Horizons or your sales team members at Horizons. So yes, we are going to open it up to questions. So we do have some questions. Nick, I'll just moderate that for you here. First one I'm going to start with is about the institutional market. Are the institutions participating in the preferred share market right now? And if not, what would you need to see? What would change for institutions to become more interested in the pref market?
That's a good one. Institution, like I said, on the new issue, they are buying a little bit. Like I said, around 20 buyers. The peak that we saw was in 2016 when BMO print with a 400 plus reset. I think if I remember correctly, we had 85 different institutional buyers. So 20 is better than 5, but it's way, way far from the big 85 that we saw in 2016, right? What's different right now versus 2015 is, if you remember 2015, well, the pref market got crushed big time, but it was one of the worst asset class in the world, right, at that time. And that's why we saw some hedge funds from Canada, from US, some life insurance companies coming and buying the asset class. In late 18, I don't think we saw, maybe some of them, but way less than in 2015, because in 2018, everything got crushed in late 18, right? Everything. So I think, well, based on the equity market and high yield market and all this, like, we saw huge demand for these asset classes, and that's why they are performing so well. And not much on the pref. In fact, preferred, we're still getting, as generally speaking, we're getting outflows still. So what do we need to see buyer back? I think that's where we are right now. We need a market that has underperformed versus everything else. So maybe some investors will start reducing equity that have performed really well and start buying preferred, right? So that, I think that's what we need. Most of these buyers, I would say, mainly more the institution buyers, the new ones, were really happy buying in 2015 the high resets, maybe less the overall market. So we didn't have these type of well, we have, but they're, I would say, not as attractive as before. But I think we could see hedge funds coming back, or other type of institutional investors, because the market is underperforming.
Okay, good. A couple more. One a broader macro question, and one more maybe stock specific or preferred share specific. So first, the macro one. You know, how would you react if the economy in both the U.S. and Canada have negative economic growth with the rate as a result of the rate increases from 2017 and 18?
The way we protect the fund, well, if we think that happened, well, of course you need to reduce your discounted resets, right?
Right.
But liquidity usually is a matter, so you need to start before, right? If you ask right now, are we buying the deep discount reset? Not at all, right? Are we reducing some of the lower resets on opportunity? Yes, right? But we're kind of switching right now. So buy one banks that have a great yield, even if it's a low reset, or buying it to like the Manulife, like I was saying, reducing other type of issues with low reset that are kind of maybe hoping for too much higher rates. So we're kind of already kind of cleaning a little bit the portfolio. Another way to protect the performance or the capital is to add cash, right? Which is what we're trying to do, have a little bit more cash than before. After that, you can increase your perpetual weight, which is also what we've been doing for a while, right? For more than 3, 4, 5 months. We're increasing a little bit of that. And we can buy bonds too, right? So these are kind of all the tools that we have available to try to outperform in these if that happens. But we don't expect negative growth this year and not negative growth next year also, right? Will be slow growth, but not negative. So and we don't expect both the bank and the Fed to cut.
Right. So you have your views. That there won't be negative growth, and there could be even one more rate increase at the tail end of this year. But if and when that changes, you do have tools available to you to get a little bit more defensive in the market. So thank you for that. One specific question, if you don't mind. Someone was asking your opinion on Enbridge.H, and if you have any thoughts on why that's performed so poorly.
Yeah, it has performed poorly like everything else, but it did better than, let's say, some of the even TransCanada, some AltaGas, some Brookfield Renewables. So it was for this time, Enbridge was not the worst, right? Enbridge H's has already reset with higher 5-year rate, so that's good news. But the price is also reflecting it a little bit, right? So if I was to pick Enbridge today, I would go for the ones that are Enbridge FA, FC, FE, F George. These haven't reset yet. These, if you can get them with a yield around 6.50 based on the 5-year rate right now, these levels are more on the bid side. I think that's the one that I prefer right now over Enbridge H. But generally speaking, you can't go wrong with Enbridge, right? And it's not just about valuation that is really attractive. By the way, you're getting 650-ish for a pref. After tax, you're above 8%, and I don't have around 8%. The hybrids Enbridge are 610 right now as we speak, even less now. So and this is interest. I know they have maybe less extension risk with the hybrids, but you're pari passu almost, right? So then preferred. So I think Enbridge is attractive. Enbridge just got an upgrade by Moody's. They're doing the right thing. They're reducing the leverage. They have reduced the complexity of their balance sheet by bringing Enbridge Income Fund, EEP within Enbridge Inc. We like this issuer, and that's the reason why it's the biggest issuer in the portfolio. They're doing the right thing for the credit, and it is still really attractive. Still way more attractive than TransCanada, that is 580-ish, right? For some of them, your pick is 70 basis points. If you look at long TransCanada versus long Enbridge, they're way tighter, right? Yes, Enbridge is turning wider, but they're way tighter versus TransCanada on the bond side. So that's why we're keeping them. We are expecting outperformance. And if you look at Enbridge versus where, let's say, Pembina, which is, we also like the credit, but you're getting the same yield. Pembina should trade wider than Enbridge, and I don't expect Pembina to underperform because we still like some of them, but I expect Enbridge to outperform Pembina over time, right? To trade tighter than Pembina. So.
Okay, thanks, Nick. I mean, obviously, thank you for your thorough answer. The listener who had that question, I'm sure, appreciated your very thorough response, and it's very clear you know your stuff in that space. So I'm just going to a couple more questions. One was a listener wondering about the swap program and if our pref ETFs can swap for individual preferred shares, and I did mention that yes, that is possible. Just be aware that there is a minimum amount, but we'll reach out to that listener after the call and see if we're able to help them. And one other final question as we're running out of time. Very simple, broad question, Nick. Why should I invest in HPR? I would touch on that first by saying, it's a very broad preferred share ETF, getting you access to all the different preferred share issuers. actively managed by Fiera Capital that has done a great job of outperforming over time over the more passive benchmark preferred share ETFs. But Nick, I'll let you expand quickly on, why would someone want to buy HPR?
Well, we have the longest track record for active ETFs, right? We launched this fund in 2010. Despite the tougher year last year, if you look at what we added in terms of alpha for over time is 150 basis points per year. That's before fees. So that's really great track record. We've outperformed in bad and markets and also good markets. So that's one reason. You invest also in a team. You invested in Fiera and the IFI team, which we have a real credit team. We're 7 on the team, and so we do all the credit analysis for the issuers, and they're on the bond side, but they're the same issuer on the preferred share side. So really, it's for the track record for the team, and for the fact that our goal is really to outperform every day, right? And we're more on like bond type of managers, not equity. So for us, every basis point counts, and we are extremely active doing switches, trading ourselves, trading with dealers. And so really, I think getting a lot of information of flows within all the dealers. We can trade size. So that's all. Like I would say, the reason why you should continue to pick HPR.
Good, excellent. Thanks for your summary, Nick. I know you have a lot of passion and you've done a great job for us, so we appreciate it. So with that, we're running out of time. So I just want to remind people with the slide showing now to contact us. We're social, so if you have any further questions or comments, you can call us on our 1-866 line or email us at info@horizonsetfs.com. We're also on Facebook, Twitter, and LinkedIn, etc. So I do want to thank Nick and thank everyone who attended today's webinar on the Canadian preferred share market. I do appreciate everyone's attendance and interest and support. If you have any other questions, please contact us. And once you leave today's webinar, you'll receive a survey on this presentation, and we would appreciate any feedback. And if you could complete that for us, that would be great. You will also receive a follow-up email within 24 to 48 hours with a link to a replay of today's webinar. So on behalf of Horizons ETFs and Nick, thank you for joining us today. Have a great rest of your day. Thanks, everybody.
Thank you.
Thanks, Nick.